Hello, my name is Brian Overby. I am the author of the Options Playbook, and I'm your host for about the next 30 minutes here on Options Guide TV. All right, well, Amazon kind of held the market up a little bit. The market wanted to get ugly yesterday, and it did. And Amazon actually was down going into yesterday's print. But amazingly, as the market always seems to do, the expected move was right around $12, and we actually see Amazon up today around $13. So we did a spread, and I was kind of thinking, I was a little surprised because I do a lot of webinars just throughout the week, but we ended up doing the cheaper spread. We did the 200-205, and with the downturn yesterday, going into earnings, which in general, if you're going to put the trades on and you're doing it as an earnings play, you would do it at the end of the day on the day that they're announcing, if they're announcing after the close. We didn't do that. And when we put on the trade, Amazon was at 192. Market went down on Wednesday or Thursday. We put the trade together on Wednesday, and now it's at up 13. So it made the move and then some. So up about 6.7% at this point in time. But we just fell a little bit short, unfortunately, in the trade that we had selected on Wednesday. And so let's run to the Tradier Pro software and let's show the trade. Still got a chip in a chair at this point in time. But we bought the 200 strike call and we sold the 205 on Wednesday when the market was at 193. But if you look at the chart, let's pull that up real quick, hopefully real quick. You see that with the downturn, it took Amazon with it. So what ended up happening yesterday really affected this trade. And normally I wouldn't mention it as explicitly, but I still would have got long Amazon going into earnings just for everything that I mentioned. And that was a highlight of earnings, was their status in AI and how AI is helping their company. And they obviously did well on the numbers, but it once again was just mainly about the conference call and everything that was said in it. So the market, we were on Wednesday, probably right around here, right at this point in time. This is where we put the trade on. But then Thursday came going into the earnings, and the market ended up all the way. It closed at 186. So definitely would have adjusted the strikes to get ready for the trade. But then now it opened, and it's positive, and it's beat the expected move to the upside. So everything that we were hoping for happened. But if you go off of Wednesday's quotes and the trade that we set up on Wednesday, the market is right at that strike price. So right now we're getting 80 cents for it. The trade that we put on was $2.10. You still got a chance, but I don't feel like, with most earnings situations, the stock will make the move on the open and then just kind of hang around there. But it could drift higher. I don't know. I guess I would probably take the trade off because I can grab 80 cents. Net is 75. Because you got the short option contract of the 205 in this. And I think I would take it off now. I think I would. Mainly because it's worth taking off. You paid $2 for it. You're down about, you paid $2.10 for it. And now it's trading for 75 cents. So yeah, I would get out of the trade. I would salvage the 75 cents and I would move on for the day if I did this on Wednesday. Once again, I would have definitely adjusted the strikes and went into the position on Thursday heading into the open, especially if you're doing an earnings trade. So it's that straightforward. And I wouldn't be so, I don't know, blunt about it, except for the fact that the whole market was down almost 2%. We had the S&P 500 index down 100 points. And that obviously Amazon got taken down with that too, with the rest of the market. All right. So we also looked at, and then that hurt our SPX trade. So I want to talk a little bit about that SPX trade that we had on. And when we did the trade, the market was at 58.30. 58.35, right? Okay, so let's go and look at the SPX right now, and you would have adjusted for sure. On Wednesday, the trade was barely profitable when we put the trade on. We had sold the 58.35 and had gone down 15 points and bought the 58.20. So right now, this trade does not look good at all. And the way that you would have adjusted the trade if the market went down is just sold into take some of the money off the table that we had on and went into a put butterfly. You still would be down. You still would be losing on the trade. You just would have took a little bit of the risk off the table by doing that trade. So when would that have happened? Well, if you go back and look at the chart, the adjustment to the trade on the SPX, you would have had to do it on Wednesday. And I probably would have, mainly because of all the earnings that we have right now in this week and it looks like we've broken out of the wedge. Yeah, so here's the pattern that I had highlighted going all the way back to August. There was a strong wedge pattern that was forming. And so these were, I actually did this on Monday when I put the lines together. And no, it had to be Monday. It came all the way up to here. Okay. And so then these are the days. Yeah, these are the days trading. And so on Wednesday, we closed down on the position on the day right around here at around 58.10. So going into the close would have been the time that you would have wanted to adjust the trade. I did say on Wednesday's call, we were barely profitable, and I would not have taken it off on Wednesday. I would have adjusted, though, because the fact that the market just started to drift lower, and then you just got cremated on it here on Thursday. So I would have definitely, and now we got a new channel. We got a whole new charting pattern that's going on. The leanings are bearish. SPX is the VIX is up. So there's just a lot of nervousness in this marketplace going into the earnings or going into the election. And I do think we got to get the election past us before the market can establish a new bullish trend, if you will. But this is definitely a negative to the marketplace. I kind of anticipated that the market was going to continue on down today. It did not, but that's just a one-day scenario. But overall, the market is starting to look more and more bearish every single day that happens. I think one of the reasons why the market has bounced back has a lot to do with what happened with Amazon. Apple also announced, had good numbers, but the marketplace once again took it as a negative. Apple has a tendency to sell off after earnings. They just always do it. Whatever they say is just not good enough for the marketplace. And usually a lot of people take some profits. And mentioned that on Wednesday that if I was looking at Apple, the trade that I would look to do is some protection, because most people own stock, and I would buy a put or I'd buy a put spread. And that's the way that I would approach Apple, but I didn't want to trade it. I wanted to trade Amazon. I liked what Amazon was doing in the AI space, and I figured that might be a reason, or might be mentioned in their conference call. And that's what really kind of drove the stock more so than the numbers. The numbers are doing really well, though, across the board. Okay, so now we got this opportunity in the VIX. If you look at the VIX, we're at 2169 up. That really jumped up, and that's down from yesterday. And so I'm going to take a peek at the VIX futures by just looking at a chain on the VIX index. And the election is next week. You could maybe do this on Monday, but the fact that the VIX is now above 20, I really do want to get short the VIX for the November expiration. I don't even mind doing it for the December expiration, but my only concern about doing the November 20th expiration is by that point in time, if it's a contested election, the news might not be out yet. And I really think that the news or the winner has to be determined for the VIX to let go of its hold on the marketplace, is just my take on it. And I don't know if November 20th is enough time, considering the date is on the 5th. That's a couple weeks. That would be a long time to not have a official winner determined. But I don't like trading the weeklies, and it's mainly because there's just not that volatility. So you notice that this symbol here says VIXW. This is VIX and the VIXW. So then you would have to go out to the December 18th expiration, and that would be the next month that I would be willing to trade. But I'm going to make this my official paper trade. We are going to do a longer term. It's going to be 19 days. And in my mind, that's a long-term trade in the VIX index. And we are going to get short volatility going into the election. And this is a trade that you're just going to put on, and you got to manage your risk by setting up the spread. So the strategy is going to be a long put spread. And if you look at the quotes right now, the way that you determine where the VIX is at, the VIX spot, this matters at expiration. And if you want to learn more about this, by the way, what I'm going to say right now, if you want to learn more about it, go to my Twitter, I guess is X handle, x.com, @BrianOverby, and scroll down. There's an article called Decoding the VIX. You can probably just put it in the search box and you'll probably find it. But that article explains how important the futures contracts are to the actual VIX index. Okay, so that's your homework. If you want a paper trade and follow along with this, you need to read that article. If everything I just said was a little confusing to you, that article will make things a lot clearer. All right, so here we go. At 20, the strike of 20, you see, and let's just look at the ask, okay? The ask is $2.29, and we'll ignore the bid. $2.29. We go over to the put side on the 20, we see that the ask is $2.21. So they're almost the exact same price, which implies that this November 20th future contract is trading fairly close to 20. It's not trading at the 21.59 where the market is at. So the market is actually higher than where the futures contract is trading. So what I am doing is something that is called a combo, where you synthetically build long stock. Okay, I don't want that to get too hairy for you. But if you buy a call, you have unlimited upside. If you sell a put, you bring in premium and it acts like owning the stock. So either if I buy the call at 20, I have the right to exercise and buy the stock at 20, or the index in this instance, and have unlimited upside. If I sell the put at 20, well, they can put the stock to me at 20. And if I own the stock then at 20, anywhere below, I have substantial downside all the way down to zero. So if you do that combination and it's trading for zero, that means, well, the stock is basically at 20, or in this instance, the VIX is at 20. All right. That's the way that the trade works. That's the math that's behind it. There is a CBOE delayed futures quote, but I notice that the futures quotes sometimes don't update as frequently. So there's issues with it. I just like to look at this, get a general feel of where the futures are at. And that's also going to make our long put spread a little bit inexpensive. So in this instance, it's going to be expensive because it's the VIX. It's that straightforward. And I did consider looking at a butterfly, but I don't think there's a need for the butterfly, because in the VIX index, when you get down, like you look at the 13 level, the 14 level, the butterfly would protect you on the downside. But the VIX has it has a level, right? It has once you get down to the 10 level, it's very hard for the VIX to get below 10 because it's implied volatility. And you're just basically saying that the 30-day implied volatility is next to nothing in the S&P 500 index options. So there's kind of a floor between, I've seen it down below 9 since they've recalculated and rejiggered the VIX, but very, very, very infrequently does it get down that low. So there was no benefit to doing the butterfly in my mind. It didn't really help us out. We're going to buy the 19 strike put right here. So I need you to move. Okay, thank you. And then at the same time, we're going to sell the 16 strike put. And right now that's trading for $1.22. What I'm saying by doing this put spread is the future's at about 20. I'm thinking after the election, hopefully we get uncontested election, basically, no regard, no political side view or anything like this. I'm just talking about a known event. That's the election that has a stranglehold on the market right now. Reason why the VIX has struggled to get below 19, even though we're close to record highs in a lot of the indexes across the board. So that there's a little bit of an oxymoron going on there, that markets are doing well. They're struggling. They're chopping a little bit now, but we see the VIX still leaning towards the high end of the 200-day moving average or of the mean. The VIX wants to trade somewhere around 15, 16. That's the norm. That's where the VIX likes to hang out at. The only time that we've really had contained volatility or sustained volatility is over the COVID. Once COVID, the pandemic came out, just to show you how hard it is for the. Let me put it this way. Let me get my thoughts straight and let me explain it well, because I'm discombobulated with it. Okay. To show you how hard it is for the VIX to stay above 20, the last time that it happened, and it happened for a sustained period of time, was COVID. COVID was announced, the VIX obviously skyrocketed, and the market tanked. It instantly started doing a V-shaped recovery, and even though the market was scary for a bit, it definitely started coming back. The whole period back, the VIX was at the VIX made its way down to the 20 level, but it took forever to get through the 20 level. Basically, I almost to the point where they said that they had the shot, the shot to be able to say, and then all of a sudden we saw the VIX drop below 20. So that's how hard it is to stay above that. You need to have some really major event holding it up, and that was the pandemic. So the major event, the only one that's really out there right now, is the election. Obviously, geopolitical concerns, but the marketplace is shaking those off a little bit. That is another big event that's out there. But this one known event is in November. So we're hoping that the VIX will go down below the 16 level, at least get to 17. I'm putting the trade on. It's $1.22. Be prepared to lose that $1.22. Don't do this trade thinking, oh, if it's down 60 cents, I'm going to get out. That's not the way the VIX is. The VIX could easily skyrocket on November 5th, right, to 60 and still easily come back down, and by November 20th be trading below 16. So once I put the trade on, I am probably in it until I'm profitable on the trade, until I want to take it off, or I'm prepared to lose that $1.22 on the trade. And I don't even mind in this instance, if you want to be a little bit less bearish, I guess. I just like the fact that it's $1.22. I can, do a 10 or 20 lot. I have no problem with this number the way that it is, and that being my risk. But if I go into this scenario, if you want to do 3 points wide is the least amount that I would really want to do on a spread, but you can buy the 20 and you could sell the 17. Now you're saying you just wanted to get below 17, and that's very feasible for the VIX to do by then, but you're paying $1.48 for it. So do you want to increase? Let's call it a quarter. Let's say $1.25 versus $1.50. Is it worth an extra quarter of risk to move it up one strike and have a 50-50 trade, right? You're paying $1.50 to make $1.50, right? It's 3 points wide. That's where you're at if you do this trade. So you might adjust it up a little bit and go that route if you would like to, but I'm going to make my official paper trade a little less pricey. And we're going to buy the 19 and we're going to sell the 16 put. So here's our trade. We're looking at the VIX index. We're buying the November 20th 19 strike put. And at the same time, we're selling the November 20th 16 strike put. We're doing this for a net debit of $1.21. Total cost for every 1-by-1 spread would be $120. We'll come back. We'll review this position. We'll probably review it at least once a week until we get up to the November 20th expiration. I'll keep an eye on the VIX. You see the VIX get down to 19, which, like I said, could happen as early as the 6th or the 7th in my mind. I don't expect much to happen. I'm taking advantage of the fact that we had the big downturn yesterday in the marketplace, and we see the VIX above 20. So this makes this spread just a little bit cheaper. And even with the futures contract trading closer to 20. So that's our official paper trade. And let me check and see if we got any questions. And if not, I hope you had we got a lot of questions. Okay. So Anthony, Amazon, 190, 200. Nice. Oh, you did a put butterfly. Anthony, why did you do the puts and not the calls? Yes, strategy was correct if you made a trade on Thursday, but you said you did an Amazon 190, 200, 207. I like that trade, by the way. So you stopped short on the modified. You went 10 points on the long spread. Anthony said, is that a trade that you did, Anthony? Well, I guess we'll leave that there. But yeah, put on. It said, okay, the Amazon butterfly put on. Okay, it's not put. It was a call butterfly. I read the word put on the comment and it got cut off. Okay, 205. Man, boom, baby. Can we keep it at 200? I love it. Yeah, modified. Look at that. Look at that right now. 199.90. Yeah, you probably got to get out of it. Yeah, I don't know. If you got more than one, way I would approach it, Anthony, is I would sell one or two. Wow, we're right at 200 right now, right? Well, we're talking during the show even. That's impressive. So what I would do is if I had more than one, let's just say I had two of them on, I would sell one now and then let the other one ride. And that's the way I would approach it. But if you just have one on, I would think about just trading it and getting out of it. Okay, let's put that up. Let me show that. Okay, so I forgot that I can click this little button and I can show it. There you go. That is Anthony's trade. Golf clap. All right. And then I got another question in here from Wayne, longtime listener. All right, Wayne, Brian, I have 100 shares of Nike. Okay, I remember your Nike position. You asked a question about it before. 100 that were put to me at 90, and I've been selling calls at 90, but with Nike now at 77, I'm collecting not much premium. Where would you sell the calls now? Well, it's your general rule, Wayne. Okay, so let's put this question. I got it up there. Okay. The general rule is if I'm selling calls, I don't like to pin myself at a scenario where I could lose money on the trade. So if your cost basis is 90 and you can't sell the 90 calls and get any premium anymore because it's moved down, but you still want to stay long the stock, I think I would just stay long the stock. I don't know if I really want to sell premium against it Let's look at like 14 days out. Yeah, the 90 calls aren't trading for anything. So you got to sell something about one standard deviation. You're looking at 82.50, right around 45 cents. That's a one standard deviation move. You obviously don't want to get pinned on it. So we got a delta of 16 here. You're going to, you'd want to stay around the 83, and you're not getting much for it. You're not getting much for that. I think Nike usually announces a little later in the cycle for quarterly earnings. Boom, let's go 800 days. And so my attitude would be that if you're going to do the buy and hold here, is I would just let it ride. I would just let the underlying stock ride. Now, one thing that you can look at, if you're just saying, I don't want the cheese anymore, just let me out of the trap. Go into the options playbook and check out a ratio call spread, or otherwise known as a back spread. And I guess I could pull that up. And that's basically a covered call on steroids is what that is. So you're down on the position. You buy an extra call in this range, but I would wait till I got back a little bit. At least I'd look at the chart. The chart is ugly. Sorry, I brought that up, and I just kind of, if you got any kids in the room, you might want to ask them to leave looking at this. But look at that downturn, and then nice solid bounce up. But man, we're all the way back to here, right in this range. We've filled the gap to the downside. You got a death cross here from the 50-day and the 200-day. Yeah, but it's holding right here, which is the end of this long candle on the downside on the gap up. So I would hopefully think it would stay right here. If it breaks below this level, you gotta get out of it. But here's the back ratio spread. I have, let's zoom out if we could, Luis. Thank you. And I'll show you that trade, and then we'll call it. I hope you had a happy Halloween, everybody. Just by the way, I really enjoyed my Halloween this year. So back spread with calls. Front spread is what we want. I'm glad I looked at this because I gave you the wrong trade. We want to do the front spread, not the back spread. Long call spread. There we go. Okay, so let's show it. Let's go to the playbook view. All right, so if you do a front spread, if you get to a situation where the stock, let's say, comes back maybe 4 or 5 points and you get to the 85 level, well, what you can do is you buy an extra call at strike A. That would be an at-the-money call. And then you can sell 2 calls at strike B because you have 100 shares of stock. So this isn't naked. You don't have unlimited risk all the way up. So I like to say it's a covered call on steroids. You do it, you're going to bring in a smaller premium than if you sold a call option. But from strike A to strike B, it's like you own 200 shares of stock versus 100. So if the stock bounced back, and I really play this like I don't want the cheese anymore, just let me out of the trap, is I'm going to be able to put the spread on for a net credit to the account. And from strike A to strike B, let's call it in Nike's instance from strike 85 to strike 90, where I'd be willing to sell this at, I would make 2 to 1 from 85 to 90. I would wait for the stock to come back a little bit, but this would be a trade that I would consider, especially if it's something where I don't want the cheese anymore. Just let me out of the trap. That's my favorite little saying, where, just please, if don't beat me up anymore. I'm ready to exit the trade if you just give me a little bit back. All right. I went for a long call with so Mega had a trade. Mega, I'm assuming that is on Amazon, correct? Nice. No, Amazon was everything I mentioned on Wednesday really played out. It's not always the case, but it did. It really did. All right. Excellent, Mega. That's awesome. All right, everyone. That's going to be it. We're right at the witching half hour, 11:30. My name is Brian Overby. If you'd like to follow me on Twitter, my handle is @BrianOverby. Like I said, type in Decoding the VIX. That's the article that I wrote on it. It's a quick read, and it's worth doing if you want to learn a little bit about how the futures affect the actual VIX option contracts. Thanks for tuning in. We'll be back on Monday for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.